Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll get better with saving, spending and investing. And today, we're continuing the journey of investing in China. So last week, I covered the big question of should you invest in China for the long term? And at the risk of repeating myself, I'm going to stress again that investing in China can be really risky. So please be careful regardless of what you choose to do. My goal is never to hype anything up, including stocks or including the country of China. So any ideas that you see here should be just taken as a starting point for you to go and do your own research. With that said, today's video is designed for those of you who've said, yes, China deserves a place somewhere in my portfolio. And the question is, how do I go about it? Or what are my options that I could consider researching further? I'll start with some of the interesting investing themes that you could consider researching further into. Then I'll move on into how you can go about getting exposure towards China. And then finally, the question of how much of China should you be allocating within your portfolio. So if you're ready, let's go! With 1.4 billion people, China is massive. And the question of what should you invest in can already be a pretty daunting one on its own. So what I've done is picked out 3 major investing themes which I've seen that are very interesting that you could probably use as a jumping point. The first major theme is the growth of the middle class in China. In its China Consumer Report 2020, McKinsey already showed that roughly 50% of the households in China are considered roughly middle class and above. I've attached the report itself in the description below so you can really dig into it. It's really quite interesting. But more importantly, it's the growth of spending amongst the Chinese consumer. And if you look at it over the past few years, it's already been growing at a high 7+%. And in 2019 alone, in the first 10 months, it grew by roughly 8%. So the question is, what areas are benefiting from all this spending? Consumers there are buying better quality household goods, they're spending on private education to give their kids a leg up, they're paying for more premium quality luxuries, there's an increased usage of financial services, and of course, there's the growth of e-commerce as well. The next big theme is healthcare, and it's not only because of rising consumer spends, but it's actually China that's an aging population. And on top of that, there's this massive government plan called Healthy China 2030. In a nutshell, it's a plan to reform the current healthcare system to try and address rising costs. And this will create a fertile ground for many different sectors such as health tech, biotech, medical services, and even medical AI. Beyond government spending, the rising living standards in China and on top of that fears of COVID have pushed Chinese consumers to start spending a lot more on healthy food. And of course, this will cause growth in all the different industries connected to healthier living. The last major theme is of course tech. It's so big that it already overlaps some of the things that I mentioned a bit earlier. But there's some specific areas of growth that's really interesting, and it's thanks to the clues provided by the Made in China 2025 initiative. Yes, it's another government plan. And it was launched back in 2015 and it was designed to help China move from a low-cost manufacturer towards becoming a producer of high-end goods. There were many sectors identified in the initiative, but there are 3 that I thought were really interesting. The first is electric vehicles, and a research report shows that there's roughly going to be 25% year-on-year growth between now and 2025. Next is robotics, which is another massive area, but you could kind of dig into the details and look at subsectors, for example, logistics. And finally, it's clean energy. And this is an area where China, surprisingly to me, is already a leader in the world. And its projections by 2030 is that 62% of its power should be derived from clean sources. And literally just this morning, I read that China has set an ambitious goal by 2060 to be completely carbon neutral. Another source of energy, but for me specifically, is when people like you decide to click on that like and subscribe button because that really helps support me and keeps my channel growing. And with all that exciting potential, the question becomes, how do I go about investing? The first method is directly buying stocks of Chinese companies, and there are a few different ways of doing this as well. You could buy China A shares or B shares, which are listed in Shenzhen and Shanghai, and they're all denominated in renminbi, or some others prefer to call it the Chinese yuan. The next option is to buy H shares, which are listed in Hong Kong, and they are denominated in Hong Kong dollars. And the final option is going through US-based stock exchanges, and you can buy N shares or you can buy ADRs or American Depository Receipts. And in this instance, they're all denominated in US dollars. So as you can tell, this can become really complicated. So unless you're really experienced or you're feeling confident and adventurous, I would choose to avoid this route or maybe walk very carefully. The next option for you to get access to China is indirectly through what you call emerging market funds. You can think of this option as China Light. And what that simply means is China is included in a basket of what they term as emerging markets. As an example, there's an ETF listed in the US called SCHE. And as part of its portfolio, 45% is allocated towards China and Hong Kong. The pros of this route is that it automatically gives you diversification within the fund, but this might not be the best option should you decide that yes, you want a dedicated portion of your portfolio specifically for China, or there's a specific theme that you wanted to invest in. And this leads us to the final method, which I think is the easiest. It is really just buying China-specific funds, and these funds will give you direct and dedicated exposure towards China. The great news here is that you really have a lot of options. The first consideration here is where you choose to buy these funds from. If you're living in Singapore and Malaysia, you can already choose to look for ETFs that are listed on SGX or the KLSE, which are already China-focused. If your broker allows it, you could also choose to look for ETFs that are listed in different countries. There is some advantage to doing that. For example, there are unique ETFs that are not available elsewhere that are listed in Hong Kong. If you wanted size and liquidity, you could look towards the US. Or if you wanted something that's tax-friendly and a little bit cheaper, you can look towards Germany. As an example, there's an ETF listed in Germany that's called the Franklin FTSE China UCITS ETF. That's a mouthful, but it's cheap and it's very tax-friendly. You can also choose to go down the unit trust or mutual fund route. This area alone is massive because you have so many different options to choose from, but the main benefit is having access to active fund managers who are experienced stock pickers. The trade-off here is you usually end up paying much more in fees, and based on what I've seen, at least in the funds in Singapore, the lowest annual expense ratio tends to be about 1.5%. So with ETFs, your expense ratios are usually lower anyway relative to unit trust, and they usually track an index or they give you access to a specific theme. But regardless of your choice, yes, start with scrutinizing the cost, but also double check the underlying holdings to see if it reflects your expectations of what you wanted. So assuming you've already decided that yes, I'm going to have a dedicated portion of it in my portfolio, the question becomes how much of my portfolio should I allocate towards China? There isn't a perfect answer here, so I've tried to use multiple references, starting with my robo-advisors, specifically with Stashaway, where I have the highest risk index of 36%. My portfolio there has roughly 20% exposure specifically to Chinese tech. I also recently opened an Endowus account, and in my 100% equity allocation portfolio, there's roughly about 4.6% allocated towards China. Another interesting benchmark is to use Allianz's research, which had a very interesting way of putting things in context. They mentioned that the market cap of China A shares amongst global equities is already at 9%, and the overall Chinese economy already accounted for roughly 15.8% of the global economy back in 2018. So based on those figures, you can kind of roughly come towards an estimation of maybe 10 to 15% of your portfolio being a good starting point. There's no absolute right or wrong or rules here, so this is really a personal choice. My current portfolio allocation is roughly 15% towards China, and in the spirit of sharing, I own a couple of US-based ETFs. So the first is KWEB, and that gives me exposure towards Chinese internet stocks. The other is KBA, which gives me exposure to 470 plus large and mid-cap China A shares. So as mentioned in the previous video, I'm still considering whether I should maybe top it up a little bit more, maybe towards a 20% allocation, or maybe diversifying further into a different theme. So I hope you guys found China as interesting as I did. I had a lot of fun doing research for these two videos. Do let me know what you decided to do in the comments below. So if you found this video entertaining or useful, I would really appreciate your support in hitting that like, subscribe, as well as that bell button, because I'm going to be back again next Sunday with a brand new video. And until then, take care and keep playing your own game.